Okay, gang. Go again. So it's 6 in the morning and we are out here. So I'm going to be sharing 5 things that you should stop doing now as a trader for long-term success. Well, now someone could be like,
well, I'm making money, this and this is happening.
but remember, something might be short-term. But if you are looking at long-term success in trading, pay close attention and you could actually even get some notes down. So to any of you guys who may not know me, my name is Daniel Ashweze. I'm a full-time day trader. I've been trading for 4 years, an entrepreneur based in Uganda. So before we dive into it, there's something that I want to make clear. Now, trading is very simple because it's you just understanding the data that is presented to you and generating trades. I mean, it's all about you understanding when to buy and sell, meaning you have to have a trading strategy, and that can be done by any person because you could actually learn all this on YouTube or even from a mentor. But success in trading is literally way more than that, and that's why I want you to pay close attention. Now, the first thing that you should stop doing now is stop the idea of flipping accounts. Now, flipping accounts might be someone trading on a small account or someone even trading on a big account, because someone trading less than $50 could be like,
Oh, I want to turn this $50 to 100.
or to $500, and someone else is going to be trading less than 10k and this person wants to flip it up to a big amount. Now, this is literally gambling or aggressive trading because I mean you're risking it all to make something in return. Well, today you could make some money, but then the next day when you lose it out, you are going to lose it out all. Now, like I said, I'm speaking this out of experience. Now, there was a time when I was flipping accounts, surely when I was getting started, and well, I would make money, but then in the long run there was no money. So don't do the same, because it's the whole same trap of you making some money, growing up your account to some big amount and then losing it all. Now, there are 2 options that you can actually take rather than you going for the flipping side. So the first thing is getting funded. Now, this is literally one of the best ways at the moment. Well, there are many pro firms now, there are many investors looking for traders who can actually make money. So meaning it's now all up to you. As long as you feel like, well, I'm very good off now with my skills, I can actually be able to make money, I can be able to grow an account, you can actually now get funded. Now, on getting a funded account, it's pretty easy. You can actually get this from a pro firm or some random investor out, because there are many people out who could have money and they want to invest in your skills, meaning if you're able to make money, this person is going to invest in your skills and you're going to make money. So at the end of the day, you are just taking a profit share and that person is taking a profit share. So this is way better because you are actually trading with more money as compared to if you are trading with small accounts. For pro funds, it's the same. You could actually buy a funded account for some, maybe $500 or $100, get an account to about 5k or 10k depending on the pro firm that you actually decide to use. I'm going to put the recommended pro firm just down in the description below, but you could actually get, let's say, a 5k account or a 10k or even 100k, meaning on 100k you could make, let's say, 10% is about 10k, and if you are taking 50% and the pro firm taking 50%, you have made some money. So that's the whole concept. So rather than you doing the flipping side because you want to make money, you could actually get funded, and then the other option is you just taking it slowly. Now, this is literally one of the best way, and it's universal, because in trading it's all about gradual growth. It's not going to take a week, it's not overnight, no way. It's going to be a gradual process. So whether you're trading a funded account or you are even trading your small capital, it's very okay for you to take it slow. Consistency is all about you making money today, the next week, the next week, and in a whole year. It's not all about you making money today and then the next week your whole account is gone. Not at all. So that's one of the things that you should stop doing now as a trader. Now, before we go to the second point, this video is sponsored by Triple FX, literally one of the best brokers, and I would recommend that you open up an account with them. I'm just going to put the link somewhere down in the description below. Now, going to the next point, stop opening multiple positions. Now, this is too much of excitement. Well, I've seen most traders saying other people, let's say on social media or anywhere,
Or your mentor opening up multiple positions.
so opening up multiple positions is all about you and your risk management. So someone else is going to open up, let's say, 0.01 lot sizes 10 times, meaning that would be 0.1 in actual sense. But that could be only 1% of their trading account, and that's okay. It could be 2% of the trading account. Now, just because you saw this person opening up multiple positions, you don't have to do the same, okay? Because the moment you open up multiple positions, it means your account is exposed to more risk. Now that means, okay, you could make some money, but again on the other side you could easily lose out your account. So it's better to open up 1 or 2 or just 3 positions alone, and actually putting into consideration your risk management. So if you are risking, let's say 2 or 3 or 4% of your account, you could open up, let's say, 3 positions and let them to run, rather than you having to open up 10 positions just because you saw
Daniel opening up 10 positions.
just because you saw someone on social media opening up multiple positions. No. And then the other disadvantage of opening up multiple position is when you are having profits running and let's say there's a news event, remember there's a volatile move and you have to close each of these positions one by one. Trust me, it's overwhelming as compared to when you have only 1 or 2 positions running. So put into consideration the other side of risk management. As long as you have your risk managed, you could open up 1 or 2 or 3 positions at a time, and that's okay. Now the next thing that you should stop doing is trading without a stop loss. Now trading with a stop loss is somewhere tempting, because at some point you feel like, well, I've done my analysis, I know what I'm doing, and I'll probably be watching the charts and I won't put a stop loss. Now I'm going to share this from my personal experience, because for most of all these things I've actually been through them and I have at some point learned the hard way. So trading without a stop loss is literally one of the things holding most people behind, because your stop loss or your take profits are one of the things that are going to keep you in trading in the long run. Because I mean, if you don't put a stop loss today, you are going to get stopped out, and more often you have actually lost more as compared to if you had a stop loss on. Now overall, trading with a stop loss is one of the most important things in trading. Now I wouldn't care whether you are a beginner trader, an intermediate, or even an advanced trader. You feel like,
well, I know all this.
Trading with a stop loss is a must. Now going to the next point. Now these are 2 things combined, so it's you letting losing positions to run and you failing to close out profits. Now I know this might sound confusing, but let me explain. Now I've seen traders holding losing positions. Someone is like,
oh, I know well it's against me, but it's going to reverse.
now who promised you? Okay, you could have done your analysis, but you won't know what's going to be happening next. So don't let losing positions to run, because at the end of the day you could easily blow out your account. Now there's also this incident where most traders are even going to adjust their stop loss. Let's say initially you had placed it 25 pips away from your entry, and now just because you see the market against you, you try adjusting your stop loss. Now that's fake, and don't do that, because you could end up adjusting your stop loss until you are 100 pips away from your entry point, and guess what, the account is probably gone by then. And then the other thing is you failing to close winning positions. Now this is a bit tricky, because I've seen people holding trades because they want to be perfect. Remember, the whole goal in trading is making money. It's not perfection. It's not all about you proving to the charts. It's not you proving to other traders, because no one cares, literally. Now what do I mean? There's a time when you could actually enter trade and it's almost hitting your take profit, or let's say it's 50% towards your take profit, and someone is like, well, I won't close this trade because
It's almost hitting my take profit.
like I say, that's not promised. So closing trades and you being able to make money is one of the most important things. So how do you go about this? So the easiest way that I do recommend is closing partial profits. So let's say you opened up 0.1 lot size, you could actually close off 0.05 and then let the other to run. Because I mean, the whole goal is you making money. So when you are making money, it means you are progressing as a trader. I've seen trades that are just a few pips to take profit, and then all of a sudden it reverses and kicks out the trader. Now going to the last point. Now this comes down to your account and how you approach it. Don't over leverage. So most brokers have up to 1 to 2,000 for the leverage. That's a trap, because if you are trading, let's say with $10 only and you are using 1 to 2,000, it means you have an account that could actually take positions as compared to an account that has $20,000 in cash with no leverage, meaning they have 1-to-1. Now what's the problem about this? So the bigger the leverage, the bigger the risk, because your account could actually be allowed to take bigger positions, but you could easily lose it out again. Now let's say you're trading with $100 or $500, the best leverage shouldn't be too small and shouldn't be too big, so you should actually look in the middle, where you could use 1 to 200, 1 to 400, or 1 to 500. That should be the maximum. Well, I'm speaking this for someone who is trading on a small account, But for someone trading with a bigger amount, you could even use 1 to 10, 1 to 50. It's actually so crazy that in some countries, brokers aren't allowed to exceed a leverage of 1 to 200. So at some point, well, you could use it to your advantage, but if you don't know how to use it to your advantage, it could go against you. So don't over leverage your account. So those are some of the 5 things that you should stop doing if you are looking at long-term success in trading. Well, like I said in the start, it's all about you being able to make money today, the next week, the next month, and the whole year, because it's a gradual process. So if you watch this far, consider subscribing, because I'm going to be bringing more of these videos and then more about money, personal growth, and you definitely don't have to miss out on this. And I'll see you guys. I'm out for today. Let's roll it.